dear students, to the massive open online course in money and financial markets. As I have promised you before, that we are going to deal with the New York Stock Exchange in today's module, and so the name of this module is International Stock Markets Part 3. In this module, our objectives would be to really understand the difference between the primary and the secondary stock market, understand the working of the New York Stock Exchange, how NASDAQ operates, and at the end, we might try to find out that how can we really calculate index or what the indices really consist of. Now, the bigger goal in this module is to really understand that who owns stocks and how the stock exchange works, how to read and understand the stock market information which are generally reported in the financial press. So at the end of this module, the students would be able to figure out the various definitions that are generally used in the press or in newspapers or in news articles about the stock exchange. Now, first and foremost, I would start my module today with the distinction between private equity and venture capital. What essentially is the difference between the two? Now, private equity is the name that is used for the rapidly growing area of equity financing for non-public companies. So, we often see that banks are generally not interested in making loans, especially to startup companies, and if those companies are small, the banks are really not interested in making loans to them. So, those companies which usually have no assets other than just the idea what they're trying to do, or those companies which are run by fledgling entrepreneurs with no track record, and firms with this profile then have to search for some other type of capital, which is essentially known as venture capital, which is an important part of the private equity markets. So firstly, what is private equity? It is the most basic one. It is the shares which represent ownership of or an interest in an entity that is not publicly listed or traded. So, private equity is a source of investment capital from high net worth individuals and firms. These investors buy shares of the private companies or gain control of the public companies with the intention of taking them private and ultimately delisting them from the public stock exchanges. So the large institutional investors, they generally dominate the private equity world, including the world of pension funds and large private equity firms which are funded by a group of generally accredited investors. Now, when I come to the concept of venture capital, so as I have already said previously, that venture capital refers to financing new, often very high risk startups and small businesses that are seen as having a potential to generate high returns of growth and above average returns, and they're often or generally we find them fueled by innovation or by carving out a new industry niche for themselves. Now, the funding for this type of financing usually comes from wealthy investors, investment banks, and specialized venture capital funds. The investment does not have to be financial in nature, but can also be offered via technical or managerial expertise. Generally, what we find that individual venture capitalist usually invests their own money. And sometimes these venture capital firms, they pull their funds from various sources like individuals, pension funds, insurance companies, large corporations, university endowments, etc. And these venture capitalists, they know that these out of these new companies, many of them might fail in future. But they also know that if any one of these companies do succeed, then they can also provide them with enormous profit. So you can very well understand here, students, that the risk factor is enormous in this case. So to limit this risk factor, we find that venture capitalists generally provide the financing in stages, and these venture capitalists actively help to run the company. So at each stage, enough money is invested to reach the next stage. And generally, there are two levels of financing for the venture capitalist. One is called the ground floor financing, and the other is called the mezzanine level financing. So at each stage of financing, the value of the founder's stocks, the value of the founder's stake grows, and the probability of success increases. Now, if goals are not met, the venture capitalists would not provide further financing. So they are basically going to withhold further financing. But if a startup succeeds, the big payoff frequently comes when the company is sold to another company or the company goes public. Either way, investments bankers are often involved in the process. So investors which provide funds are gambling basically that the newer company will deliver and they are not going to deteriorate. However, the trade-off is potentially above average returns if the company delivers on its potential. For newer companies or those with short operating history, like say 2 years or less, the venture capital funding is both popular and sometimes really necessary for raising funds for these type of entrepreneurs. And this is particularly the case if the company does not have access to capital markets, bank loans, or other types of debt instruments. A downside naturally for this type of fledgling company is that the investors often obtain equity in the market, and therefore they usually start having a voice in the decisions of the company. The next topic that we are going to talk about is how are these securities sold in the public. Now, as we have already learned in our previous modules, that there are generally two types of market. One is a primary market and the other is a secondary market. Now, in the context of the primary market is generally a market where investors purchase newly issued securities. So, for doing that, we have an IPO or initial public offering. An IPO occurs when a company offers stock for sale to the public for the very first time. And then secondly, we have this SEO or the seasoned equity offering. That means if a company already has public shares, so SEO occurs when a company wants to raise more equity. So then the company goes for SEO. Then we have the secondary market. It is a market where the investors trade the previously issued securities, and this trade the investor can do directly with other investors, or they can do it indirectly through a broker who will arrange the transactions for the others. And thirdly, they can deal with with a dealer who buys and sells securities from inventory. Now, if we try to understand the various steps or procedures that is generally followed by an IPO or initial public offering or a SEO, it generally takes place in this way. Firstly, we find that the company appoints an investment banking firm to arrange for financing. Secondly, the investment banker designs the stock issue and arranges for fixed commitment or best effort underwriting. Thirdly, then the company is going to prepare a prospectus, and the company usually does this with some sort of outside help and submits it to the Securities and Exchange Commission, SEC, for approval. The investment banker will circulate the preliminary prospectus, which is generally called the red herring. Upon obtaining the Securities and Exchange Commission approval, the company finalizes the prospectus. And then the underwriters will place announcements, which are usually known as tombstones, in newspapers, and then they will start selling the shares. These are different process how IPO is generally released in the market. Next, we come to the price, how the pricing takes place. Now, we have two concepts here. One is called the bid price and the other is called the ask price. Now, what is a bid price? The bid price is a price that the dealers pay the investors, and the price investors receive from the dealers. What is the ask price? The price the dealers receive from the investors and the price the investors pay to the dealers. So difference between this bid price and the ask price is called the bid ask spread, or simply we can also use very simply the word spread. So the difference between the bid price and the ask price is called spread. Now, as we analyzed how prices are made and how the IPO is generally brought out, now when most common stock trading is done, it is directed through an organized stock exchange, or sometimes it is also called the trading network. So whether a stock exchange or trading network is there, what is the goal? The goal is generally to match investors who are wishing to buy stocks with investors who are wishing to sell the stocks. So whenever this match takes place, then only the buying and selling will take place in the market, and then only we are going to have the secondary stock market in operation. We come to the concept of the stock exchange. In all my previous modules, I have talked about the Tokyo Stock Exchange. We talked about so many other stock exchanges like in Germany and so on. But in America, how did this concept of stock exchange started? The American security traders, they started a process of self-regulation in September 1791, broadside, memorializing a meeting of the dealers in the public funds in the city of New York, which is held at the Coffee House. At this meeting, held only a few months after the onset in New York of daily public auctions of federal government debt, we find that an unknown number of dealers, they agreed to be governed by a set of around 14 rules. Some of these rules, they attempted to cartelize or to form a cartel the occupation of stockbroking. And at that time, only a few years old in the United States. So America at that point of time was very new to this concept. While in England, it was around a century old. We had the London Stock Exchange there and people were actively trading. Now, these rules, they agreed to follow this set of 14 rules, and there we find that signatories were prohibited from attending auction sales which are conducted by an auctioneer who bought or sold stock on his own account without employing a broker. So those who signed this rule or who signed these 14 rules, they were prohibited from attending any sort of auction sales that were conducted by an auctioneer who bought or sold stock on his own account without employing a broker. Then we had another rule where they forbade participants from doing business with any auctioneer who did not sign the agreement. So only those signatories of the agreement who had signed the agreement, they could carry on this buying and selling. Nobody else could do so. But we find that there was a great market crash in 1792. Public securities auctions in New York came to a halt, which meant that the 1791 agreement had little chance to have any further impact or effect. In May 1792, the very next year, 24 New York brokers, there were around 22 individuals and two firms, and these two firms that I'm talking about had basically two individuals at their helm. They signed another agreement, and this agreement is famously known as the Buttonwood Agreement. And in this agreement, there was a single sentence in length saying that these people pledge not to buy or sell from this day from any person whatsoever any kind of public stock at a less rate than 1/4% commission, quote unquote. So there was only one rule, only one sentence in this Buttonwood Agreement. And this second agreement was another attempt at the formation of a cartel, just like the previous one. But sadly, this also appears to be equally unsuccessful. However, we find that trading nevertheless continued among those who had signed the 1792 agreement and others, despite the absence of any sort of self-regulation. When the market for foreign debt securities rapidly expanded, we find this taking place during and after the War of 1812, the brokers again tried to organize. And this time, the organization of the brokers were more successful. In 1817, 27 brokers, there were 19 individuals and 8 firms. They constituted themselves as the New York Stock Exchange Board. And as the name suggested, the board was established to trade not just stocks and currency, but also currencies and specie as well. The brokers adopted an initial set of 17 rules to govern the trading and the admission of new members. The New York brokers may have copied a similar organization that was already there in existence in Philadelphia, although we are very unclear about how it really worked. Now, let us try to look at really how the New York Stock Exchange, chronologically, if we try to look at the timeline, how it really came into effect. Now, the New York Stock and Exchange Board, they had remained very small by modern standards throughout the first half of that century. In 1820, the membership was around 39. By 1836, the board reported that it consists of around 50 persons. Membership went up to around 75 by 1848. New members could be proposed by any existing member of the board. Admission to the board was usually done by secret ballot of all the members. 3 negative votes by any of the members was enough to deny admission to any of the new members. The minimum qualification for admission fluctuated over the years. The board's initial 1817 constitution required prospective members to have been in the business for the term of 1 or more years, either as a broker or as an apprentice. But within the year, this requirement was stiffened, mandating a 2-year apprenticeship to an existing member of the board. In 1820, the board again opened admission to brokers with a year's experience. The board began changing initiation fees to the new members in 1820, in 1820, the fee was set at around $25. The size of the initiation fee thereafter served as a rough barometer of the board's growing power. The amount basically increased to around from $25 to around $150 by 1833 and around $400 by around 1848, which was equivalent to around several thousands of dollars in the 20th century. And this rate of growth is even larger than it appears because the period that I'm talking about was a period of deflation. The cost of living had declined approximately by around 17% between 1820 and 1848. When I talk about trading now, we find that trading was generally conducted at closed meetings in a large room. The president of the board called each security one by one. As each one was called, members wishing to sell would say so, and the members who wanted to buy would then bid for the stock that is being sold. The price at which the sales were completed was transcribed by the board secretary, and then the prices were reported to the newspapers. The composition of the list of the stocks called was apparently set informally in the early years, as the board had no written rules governing the subject. By 1856, however, the process had become more formalized. Parties seeking to have a stock listed to the board would have to file an application, which was then put to a vote of the members. By 1860, the New York Stock and Exchange Board, although still a relatively small organization by the 20th century standards, was the largest security exchange in the United States. And this effectively set stock prices nationwide and was beginning to stand in contemporary consciousness as a symbol of the overall health of the economy. So nowadays also we know that the functioning of the stock exchange, the performance of the stock exchange, that really is a barometer for the health of an economy. And it all started from more or less in 1860, when people began to understand that the health of the New York Stock Exchange basically was trying to define the financial health of the economy, of the US economy. So what exactly we have learned till now, that the New York Stock Exchange, it was popularly known as the Big Board. It occupied its current building on the Wall Street. This occupation started from 1900. For 200 years, the New York Stock Exchange was a not-for-profit organization, okay? So it was called the New York State Corporation, not-for-profit New York State Corporation. The New York Stock Exchange went public in 2006. So the New York Exchange NYX stocks were listed on the New York Stock Exchange. In 2007, the New York Stock Exchange Group merged with Euronext to form the New York Stock Exchange Euronext, the world's largest exchange. Historically, the New York Stock Exchange had 1,366 exchange members, and these members were said to own seats on the exchange. They collectively owned the exchange, although professionals managed the exchange, and they regularly bought and sold seats. Now, if I talk about 2005, the record seat price was around $3 million in 2005. Seat holders could buy and sell securities on the exchange floor without paying commissions. However, when New York Stock Exchange went public, all these things changed in 2006. Instead of purchasing seats, exchange members started purchasing trading licenses. And this number was limited to around 1,500. In 2007, a license would set you back a cool around $55,000 a year. Having a license entitles the holder to buy and sell securities on the floor of the exchange. Next, we try to find out who are the types of the New York Stock Exchange members. The largest number of New York Stock Exchange members, they are registered as commission brokers. So commission brokers execute customers' orders to buy and sell the stocks. A commission broker is an employee of a brokerage firm who receives payment for the number of trade they execute for their clients. And these type of brokers typically earn a percentage of the client's assets traded, meaning the more a client trades, the more money these commission brokers make. The second very important member of the New York Stock Exchange, they are called specialists or market makers. At one time, a specialist was a term by the New York Stock Exchange to refer to a member of the exchange who acted as the market maker to facilitate the trading of a given stock. The New York Stock Exchange has given a new name now to them, and they are now designated as Designated Market Makers, DMM. So instead of specialists or market makers, they are now called Designated Market Makers or DMM. The market makers are obligated to maintain a fair and orderly market for the securities that are assigned to them. Now, again, there is some other members. They are called floor brokers, or they are also called the $2 brokers. So when commission brokers are very busy, they may delegate some orders to these floor brokers or the $2 brokers for execution. Now, nowadays, however, these floor brokers have become less important because of the efficient super dot system. What is a super dot system? DOT, dot means designated order turnaround. Now, the super dot allows orders to be transmitted electronically directly to the specialists. You will very often see the floor brokers. They are often seen in media depictions of trading at the major exchanges, especially when notable market events are occurring, such as a popular IPO is being launched, or you find that there is a dramatic market crash. Now, the New York Stock Exchange floor brokers are known for their iconic blue jackets, which they wear on the trading floor. All of them would be wearing their blue jacket. The key challenges that are generally faced by these floor brokers is to obtain the best possible trade execution on behalf of their clients, meaning the best price by bidding against other traders to receive the best terms available for every purchase or sale of the securities. Upon completing their order, the floor broker will notify the client by way of the client's registered representative. And the floor brokers also receive a commission for the trades that they execute. Apart from the floor brokers, there are some other type of members. They are known as floor traders. Now, who are these floor traders? A small number of the New York Stock Exchange members, known as floor traders, they independently trade for their own accounts. So before introducing computer screens, trading floor or pit trading presented an active environment. And this was a very common scenario in the stock exchanges. However, we still do find floor trading present in few exchanges, even though the electronic trading system generally dominate. For example, the New York Stock Exchange conducts a small percentage of its trade on floor, and the New York Stock Exchange floor traders still exist. So this is how these are basically the participants of the New York Stock Exchange. The initial and the annual listing fees are charged based on the number of shares that are there. To apply for listing, the companies generally have to meet certain minimum requirements with respect to the number of shareholders, trading activity, number and value of shares that are held in public hands, and also about the annual earnings. Now, if we try to understand the operation of the New York Stock Exchange, the fundamental business of the New York Stock Exchange is to attract and process the order flow. Back in 2007, the average trading volume on the New York Stock Exchange was over 2 billion shares a day. So you can expect now at this point of time, what is the volume of trading that takes place. If we look at an average individual breakdown of this volume in 2007, the 2 billion shares that I talk about a day, about one third was generally from individual investors and about half from institutional investors, and the remainder really represented the New York Stock Exchange member trading, mostly from specialists who were acting as market makers. There are a number of specialist posts, each with a roughly figure 8 shape on the floor of the exchange. At the telephone booths, commission brokers receive the custom orders. They walk out to specialist posts where the orders can be executed, and they return to confirm the order executions and receive the new customer orders. And as I've already said, the coat colors indicate the person's job or position in New York Stock Exchange, the color of the coat. Now, this table here shows what are the various order types in the stock market. We have a buy and sell. If we have a market order, the buy at best price available for immediate execution and the sell at the best price available for immediate execution. We can have a limit order, that is buy at best price available but not more than the preset limit price. Forgo purchase if its limit is not met. And sell at the best price available but not less than the preset limit price. Forgo sale if limit is not met. Then we have a stop order, that is convert to a market order to buy when the stock price crosses the stop price from below. This is the buy part. The selling part is convert to a market order to sell when the stock price crosses the stop price from above, and this is also known as a stop loss. And then finally we have the stop limit order. The buy portion of it is to convert to a limit order to buy when the stock price crosses the stop price from below, and sell is convert to a limit order to sell when the stock price crosses the stop price from above. Lastly, we now come to the NASDAQ. The name NASDAQ is derived from the acronym NASDAQ, which stands for National Association of Securities Dealers Automated Quotation System. NASDAQ is now a proper name in its own right. It was introduced in 1971, and the NASDAQ market is a computer network of securities dealers who disseminate timely security price quotes to the NASDAQ subscribers. The NASDAQ has more companies listed than the New York Stock Exchange. On most days, the volumes in NASDAQ exceeds the NYSE volume. NASDAQ trading is almost exclusively done through the dealers who buy and sell securities from their own inventories. Like the New York Stock Exchange specialist, the NASDAQ dealers use their inventory as a buffer to absorb the buy and sell order imbalances. The NASDAQ is usually made up of three separate markets. We have the global select market, the global market, and the capital market. In the late 1990s, the NASDAQ system opened to Electronic Communications Network, the ECN. The ECNs are basically websites that allow investors to trade directly with one another. So here I have just shown a small screenshot as to how the trading on the web usually takes place. And so we find that the NASDAQ network provided a bid and ask prices as well as recent transaction information. The bid and ask price of the NASDAQ represents the insider quotes, that is the highest bid and the lowest ask. For a small fee, you can have access to level 2 quotes. So you can display all the bids and asks and frequently displays the market maker identity. Now, who are the competitors of the NYSE and NASDAQ? The third market is an off-exchange market for securities which are listed on an organized exchange. The fourth market is for exchange-listed securities in which the investors trade directly with one another, usually through a computer network. While for dually listed stocks, regional exchanges also attract substantial trading volume. Now, from where exactly in the United States do we get the stock market information? The most widely followed barometer of the day-to-day stock market activity is the Dow Jones Industrial Average, which is usually called the DJIA, or very short we call it Dow. The DJIA is an index of the stock prices of around 30 large companies, representative of the American industry. Here I have shown you the Dow Jones Industrial Average, a screenshot of how the Dow Jones Industrial Average looks like. Now, before I end this module, I would also like to hit upon some very small definition of what do I really mean by stock market indexes. Now, indexes can be distinguished in four ways. One is the market covered, the type of stocks that are included, how many stocks are included, and how the index is calculated. So if it is a price weighted one, like example the DJIA, the Dow, versus value weighted. Now Dow is basically price weighted, while S&P that we know exists is a value weighted S&P 500. Stocks that do not trade during a time period causes index staleness over that time period. That is, we do not know the true index level if all the stock prices are not updated. That is, if they are not freshened. Now, for a value-weighted index like the S&P 500, companies with larger market values will usually have larger weights. While for a price-weighted index like the Dow, high-priced stocks receive higher weights. This means stock splits cause issues, but stock splits can be addressed by adjusting the index divisor and so on. So, more or less, I finished today's module by giving you a total overview of how the New York Stock Exchange do work, who are the participants in the New York Stock Exchange, what exactly is NASDAQ, and we usually hear about Dow. What exactly is Dow? Thank you.